Hi, Colin. My name is Evan O'Connor, CEO at Oak Street Investment Partners. Today, me and my team are going to talk to you about our new investment fund, aimed at medium to high risk willing investors. We hope that after this presentation, you will be convinced to invest with us. Here at Oak Street, we believe that the future lies in sustainable investment. Our fund is based on three sectors: renewables, healthcare, and property. We've invested in multiple equities for diversification purposes and to obtain a higher return with less risk involved. My team and I will now take you through the aspects of our investment fund. Tom will begin with the macro outlook.
So, as we mentioned, we adopted a top-down investment approach. As Chief Macro Officer, I put together an outlook for the global economy over the coming months and years by analysing forecasts for economic activity, consumer behaviour metrics, and other indicators for sector performance. I was able to identify potential areas to invest in. COVID-19 obviously plays a big part in the economic outlook for every region at the minute, with Europe experiencing a second wave and the US still in its first wave that never really ended. Demand for healthcare facilities necessary for diagnosing and treating the virus will continue to grow into the future. COVID-19 also impacted demand for oil, and as countries strive to reduce their carbon footprint, investment in renewable energy and its demand is likely to grow over the coming years. Property is also an interesting area to consider. COVID-19 has caused a large proportion of the workforce to start working from home, leaving many commercial properties vacant and thereby declining demand. Once we identified these areas to invest in, we then set about identifying strong performing equities in each sector.
Hologic is our main investment in the healthcare sector. We believe that Hologic has great opportunities for growth in the medium term. The company became profitable this year with a very high return last year, exceeding the US market return of 20.9%. Compared to a lot of healthcare stocks in the global environment, Hologic is not believed to be overvalued. It has a price to earnings ratio of 16.4%, much below the average in the industry of 40%. Being a main supplier of the coronavirus tests, which will continue to be needed in the future, we believe Hologic is a great addition to this fund. We have selected Abbott Laboratories and ResMed stocks to go short on in the medium term. Both companies are overvalued, and we believe will drop down to their fair price in the medium term. We want to capture this potential profit in our fund, which other funds would have ignored due to the potential of risk involved. Tom will now take you through the qualitative analysis of renewables.
What stocks we chose in the renewable sector, those with the most dominant weights were Brookfield Renewable Partners and the Renewable Energy Group. We found the Renewable Energy Group to be undervalued with a low PE ratio relative to the industry, despite strong growth forecasts in earnings per share. After 3 years of making a loss, they've begun to make a profit, despite difficult times, and expect revenue to grow a further 11% over the coming year. Its emphasis on R&D is likely to improve their product and allow it to outperform the market in the coming year. Brookfield Renewable Partners leadership has shown their prudence in allocating capital, navigating the uncertain times excellently. They've reduced costs while acquiring and developing utility-scale electricity generating assets. The non-cyclical business cycle with confirmation of long-term contracts and expected dividend growth to 8% annually are some of the indicators that this stock will perform strongly in the future.
Once we had decided on the individual companies we want to invest in, we needed to find out what weights would give us the greatest return and minimize risk in our portfolio. We calculated an efficiency curve using a correlation matrix. We then used this to find a tangible portfolio which maximized returns and minimized risk. Using data from the previous 3 years, we made forecasts using Monte Carlo simulations, which gave a monthly return of 3.42% and a standard deviation of 1.79%. This means that if you invest your €10 million with us, your expected return after 3 years will be €33.5 million. This is of course assuming that these companies continue to grow at similar levels to before, which from our macro outlook and quantitative analysis, we definitely expect to happen. I'll now pass you over to Kate, who will talk to you about risk and taxation.
So Oaktree is exposed to the general level of risk that is inherent in investing in the stock market. Our biggest risk, which is currency risk, comes about from a high level of exposure to the US dollar. Steps, however, have been taken to mitigate this risk in that we have entered into a cross-currency swap agreement with Bank of Ireland. This will essentially lock in any future profit that we receive in the US dollar at a favourable rate and protect us against unfavourable movements in it in the future. Some other risks that the fund might be exposed to are the likes of market risk, liquidity risk, and counterparty risk. Now, on the taxation side of things, as an Ireland domiciled fund, we benefit from a double tax treaty that is in place between the US and Ireland and OECD countries and Ireland. And this allows us to benefit by paying tax on dividends and tax on capital gains at a lower rate. Now, real estate investment trusts are also considered to be quite a tax favourable investment, and this is due to the fact that dividends are the only income tax that we are subject to. So Toll Brothers is not subject to corporation tax due to the fact that it pays at least 90% of its income to shareholders, and the fund is also not liable to capital gains tax due to a less than 10% ownership in the Toll Brothers Real Estate Investment Trust.
We performed an analysis of the portfolio for the month of November and compared it to the performance of the S&P 500 for the month of November also. We found that it outperformed the S&P 500 by quite a substantial margin, despite the return on the S&P 500 being 11%, which is way above average for the month. If you invested 10 million at the outset in our portfolio, the value of the portfolio at the end of the month would have been 1.17 million, just over 1.17 million euro, which is a return of over 17%, which is a very substantial return. Although we believe that due to the outcome of the presidential election and the fact that a few vaccines were released may have had an impact on such a high return, and don't expect that necessarily to continue every month, due to our policy to short sell on stocks, we believe that the return on our portfolio will still be quite substantial for our investors over the subsequent months. And I'll hand you back to the CEO there now.
We now have illustrated the potential reward for investing in our new investment fund here at Oak Street Investment Partners. Investors, of course, need to be aware of the rapid change in the global market environment at this time when making their informed decision about investing in the fund. Thank you for your time, and we hope you will consider joining us here at Oak Street Investment Partners.